What is going on, guys? It is Trader Cause, and today I am recording the long-awaited risk management video. I think it's a great time to record it because people are making a ton of money from the bull market right now. It's April 14th, and Bitcoin is trading at around 64K. And I just want to make sure that everyone who watches this, everyone who follows me on Twitter, can actually keep the majority of the money that they're making during this bull market. In 2017, we saw so many people make a ton of money from the bull market trading alts and trading Bitcoin and Ethereum and whatever else. But then they ended up giving back a lot of that money. So one of the things that can really help you is having strict risk management and following those whatever rules you decide to set for yourself. And it's not something that is complicated at all. It's not rocket science or anything like that. It just takes discipline. And so in this video, I want to give you guys the tools to have good risk management, and it is up to you how disciplined you want to be and where you go from there. So let's jump into it. So in trading, there are two types of risk management. There's the actual trading risk, which is losing money on trades, which is pretty much what this entire video is going to be about. And then there's counterparty risk, which I thought was worth mentioning. We're not really going to focus on it other than this slide, but especially in crypto, there are just so many unregulated exchanges, and you never know if one of those exchanges is going to exit, scam, or freeze your funds or not let you withdraw. I guess that's the same thing as freezing your funds, but you don't know what's going to happen when they're unregulated, and you can't really go after them because of that. So one thing that you can do is spread your money across exchanges to diversify where your funds are. That way, if you have a little bit of money on some sketchy exchange and they end up going bankrupt or whatever, taking all your money, you won't be completely financially ruined. And then there's a reason exchanges offer margin. You don't need to hold all your money on an exchange to enter your desired position size. So that's what we use margin for. It's so that we can limit how much money we have to hold on an exchange. It's not so you can put your entire account on 100x leverage, but we will get into leverage and margin shortly. And so I guess just what I want to say here is make sure you're keeping your funds safe. You can keep your spot holdings in some kind of wallet or even on a more regulated exchange like Coinbase or Kraken or whatever. Just I would just be careful with where you're holding your money and not to just have it all on scammy exchanges. So let's talk a little bit about why risk management is so important. I have this cheat sheet here from Edgewonk, which I think I've tweeted this a few different times. I always keep it handy, and it's something very useful and definitely can help some newer traders understand why they need to manage their risk. Trading's a marathon, not a sprint. We're playing the long-term game here. You don't need to try and hit home runs every single trade, and you really need to protect your capital. A third point here is capital preservation is key, and the reason for that is drawdown. We'll go through all 6 of these, but the R multiple and required win rate, if you don't know what R is, we'll talk about that shortly, and you can come back to this, but it basically means that this shows the win rate that you need to break even if the trades you're going for are the following R multiples. The drawdown one is super interesting. Drawdown can completely mess you up mentally, and literally it can blow your account. And this is why I say capital preservation is key. So let's say you have $100. You lose 5%, which would be $5. It takes 5.3%, a 5.3% gain to get back to your $100. Let's say you lose 40% though, down to 60. It's going to take a 67% gain to get back to 100. You lose 70% of your account. you're going to have to gain 233% to get back to break even. And we hope this doesn't happen, but if you lose 90%, you nearly need to, you need to 10x your account to get back to break even. So you need a 900% gain. So that's why drawdown can destroy you. It can completely nuke your account, and then you are desperate to get back to break even, and it's a lot harder to get back up than it is to lose that money in the first place. So I like to keep this handy, or at least point it out to people who are newer traders, just to give them an idea of how important that is. Losing streaks is also important. If let's say you're risking 3% per trade and you lose 5 trades in a row, you're down 14.1%. This graph here shows you the likelihood of losing consecutively based on what your win rate is. So let's say you have figured out that your win rate is 40%. So there's a 13% chance that you lose 4 trades in a row, which isn't like a statistical anomaly. 13% isn't that unlikely to happen. It's not going to happen all the time, but it's not super unlikely for that to happen. So I think knowing that can kind of help you mentally. If you have tested your system pretty thoroughly, you have a lot of data, you have around a 40% win rate, excuse me, and you lose 4 trades in a row, you don't need to panic thinking that you've completely lost your edge, that you don't know how to trade anymore. You can take some solace in the fact that losing 4 times in a row with a win rate of 40% isn't completely absurd. So we'll talk about this a little later. I have a better chart that kind of depicts that. Moving on to stop losses. So now I want to talk a little bit more about trading itself and how to manage your risk. So you need a stop loss to manage your risk. You need a stop loss to know where your trade idea is invalidated, and you need a stop loss to know how to calculate your position size. If you don't understand yet, that's okay. I think we're a couple slides away from calculating position size. But I would encourage you guys to never enter a trade unless you have your stop loss planned out. So don't buy anything unless you know where you're wrong. Don't sell anything or short anything unless you know where you're wrong. These stop losses will protect you when a trade goes against you, and they will help you limit your losses. If you're watching this video, I'm sure you have a general understanding of what a stop loss is, but I wanted to bring that up anyway, because I'm sure there will be some beginners here as well. So let's move on to the third point. Should you move your stop loss? Now, this is a very highly debated question among traders, and I will tell you what I think personally. I think moving your stop loss is fine, but you need to move your stop loss to where your new invalidation point is. I guess the idea I want to talk about a little more is moving your stop loss to break even. A lot of people say, like, okay, when your trade goes however far in profit, move your stop loss to break even so that it's risk-free, so to speak. But that's not really the case, and I don't think you should ever really move your stop loss to break even, because why would your entry be the new invalidation? Like, moving a stop loss to break even, you're just moving it to a completely arbitrary level, and your stop loss isn't necessarily where your trade is invalidated. It's just where you think you're protected. So that's kind of why I think moving a stop loss to break even is not ideal, but if you've tested your strategy and you're more profitable that way, like, go for it. That's just my opinion. I think there's a time and a place for moving up your stop loss. I personally move my stop loss up with market structure, so when I have a new invalidation point, but break even is, like I said, just an arbitrary level. It's not necessarily right under your next support line. It's not necessarily where you think your trade idea is wrong. you're no longer trusting your trade setup if you move your stop loss to break even. You're saying, I don't feel safe in this trade. I want to move my stop loss to break even so that the worst that can happen is I don't lose any money. But I think you're missing out on opportunity if you do that. So I have an example here. I apologize if it's a little blurry, but I have a chart example of why you shouldn't move your stop loss to break even. So let's say you had this support line here. This isn't necessarily a trade I took or that I would take. I just wanted to show a example. So let's say you entered this trade. It's around 54,500, and you start to see this push away. And when you see it push away there, maybe you're like, okay, I'm going to move my stop loss to break even just to protect myself. But we hadn't really made a higher high. We didn't break out from this structure, so it's not like you had a new invalidation level, but you wanted to protect yourself, so you move your stop loss up to break even, and then you can see what happens. The market pulls back a little bit, tags that support level once again, and then pushes away and eventually hits your target. So that's just one of many examples. I honestly find quite a few examples when I'm in trades personally where I enter and price immediately moves away, or maybe not immediately, but pretty quickly moves away from my entry, and then maybe later has a little bit of a rounded retest and then comes back to test it and then takes off from there. So if I moved my stop loss to break even, or if you moved your stop loss to break even on this trade, you missed out on a winning trade and you exited at break even. So if you look at that in the bigger picture of things, if your win rate is 40% and this would have been one of your wins, but it ends up being a break even, and then you lose your next two trades, instead of being up overall, you're down quite a bit because you made that simple error of moving your stop loss up to break even. So I can make a completely separate video about how I trail my stop loss up, but just quickly I can show it on this chart. So we made this low here, kind of had an equal high. We weren't able to break through this resistance right there. Came back, made a higher low because this low here held, and then had a nice impulsive move away from our entry. So at that point, I would have moved my stop loss to the low of this wick right here, which isn't necessarily break even, but I think that's where my new invalidation point would be. Because if we came down and made a new low, then this would just be a ranging environment, and my idea probably would have been wrong. So I like to move my stop loss up with market structure, and I don't move my stop loss to break even because I just think there's no technical reason for moving your stop loss up to break even other than just protecting yourself. So next, let's talk about risk to reward. So you've probably seen on Twitter that people say like, oh, this is a 3R trade or a 4R trade, 2R, whatever it is. That's kind of how people abbreviate risk to reward. Essentially, it is just how much you're risking, or the ratio between what you're risking and what your reward is. So in this example that I put in here, your stop loss is 2% away, the target's 5% away, the risk to reward ratio is 2.5. So one thing I want to say about this is when you are entering a trade, you don't want to force fit your risk to reward. So don't tighten your stop just to make it look like it's a higher R trade, or don't extend your target to something unrealistic just to make it seem like it is a better looking trade, because that just will not help you. High R trades aren't necessarily better. I know they might look sexier to hit like a 10R, a 15R trade, something crazy like that, but usually you're giving up your hit rate to have a higher risk to reward. So, and if you have high risk to reward and also a high hit rate, like, congratulations, you have cracked the code. But typically, if you, let's say you go for like 7, 8, 9R trades, your win rate is going to be much lower than if you're going for 2 to 3R trades. And Personally, most trades that I take end up being between 2 to 4R. And I have found that that is a lot more healthy for my mentality. I don't want to lose 6, 7, 8 trades in a row and then hit one huge 10R trade like that. I think that just takes a huge toll on your mentality. And I have found that when I'm taking more realistic, lower R trades, I'm winning more trades. I just feel better about them. And also, I just think it's healthier for my mentality to be winning more trades than for going for home runs. So I think a lot of people sleep on like 1 to 2R trades even. If you're risking 2% of your account on a trade and you have a decent sized account, like a 1R trade is nothing to complain about. It's nothing crazy, but like that'll pay the bills. So that is a brief overview of RR, or risk to reward, R as people usually refer to it. So margin trading, this is kind of the main topic that probably everyone is watching this video for. So we'll start off with a definition. Basically, margin trading, according to Investopedia, margin, is the money borrowed from a broker to purchase an investment, or in our case, it's the money that we borrow to enter even bigger position sizes. So margin trading brings on a bunch of other risks that you don't have if you're just trading with spot, like liquidation. So if you're just trading with spot, liquidation price is just zero. Like the price at which you lose your entire investment is $0 if you're just buying the asset itself. However, if you're buying something with leverage or with margin, let's say you're using 5x leverage 5 times, and you're putting up essentially 1/5 of the money to purchase an asset. Well, if that asset drops by 20%, you lose all your money. That's your liquidation price. So that is something that you need to be aware of. I always tell people that their liquidation price should never really be a factor. You should never be risking liquidation because your stop loss should be well above that level, but it's still something good to know. Cross versus isolated margin. We're going to talk about this a little bit more when we talk about position sizing, but I guess that's my next point right there. Cross margin is basically just using as much of your funds as are available. Using as little of your funds as available to enter a certain position size, and then isolated margin is just a fixed leverage, like 2x leverage or 5x leverage or 10x leverage or whatever. But the bottom line is that margin does not change your position size. Margin doesn't change how much money you make on a trade. It all comes down to position sizing, which I will explain right now. So to figure out your position size, you have to know what you want to risk on a trade. And once you've decided that, I'll say most commonly people will say like 1 to 3%. If you are more risk averse, you can have 1% risk on a trade, or if you're trading a really big account, whatever. It's honestly just comes down to what you are most comfortable with. So most of the trades I take are in that range, 1 to 3%. Sometimes it depends on the setup that I'm taking. If I know a certain setup that I have has a higher hit rate, I'm more comfortable risking more on it. So just as an example. But once you've decided, you can calculate your position size for that trade, and this is the calculation for it. So it's the portfolio size times your risk percentage divided by the percent distance from your stop loss. So let's do this example with a $100,000 account, and let's say you want to risk 3% of your portfolio. And this is your setup right here. So your target is 5% away, your stop loss is 2%. So we would do $100,000 times 3% divided by distance from the stop loss is 2% right here. So our position size is 150K. So we're entering this trade with 150K, and it doesn't matter if the leverage is 1x, 2x, well, it has to be above 1x because you're entering a 150K position size. But it doesn't matter if your leverage is 2x, 3x, 5x, 10x, whatever, 20x. What matters is that you're entering 150,000 contracts. The amount of leverage just changes how much of your own money is in that trade. So if you're using 10x leverage, then you're only putting up $15,000 and you're borrowing the rest, the $135,000. If you're using 5x leverage, you're putting up $30,000 and you're borrowing $120,000. But no matter what, if you get stopped out, you're losing 3%. You're losing $3,000. So that is the main idea behind why position sizing is the key. It doesn't saying, oh, I use 2x leverage or 5x leverage or 10x leverage. That doesn't tell you anything, because if I'm using 10x leverage and 15,000 of my own dollars, or if I'm using 2x leverage and $75,000 of my own money and the rest borrowed, and it's all for a $150,000 position size, then it doesn't matter. It doesn't change how much you make or how much you lose. It all just comes down to position size. So let's do another couple calculations just so you guys can understand this a little more. So let's say our stop loss is 1% away. So let's go back to our equation. We do $100,000 times 3%, which is our risk percentage still, and then divided by 0.01. I shouldn't have an equal sign right there, so ignore that little typo. And that would give us a position size of 300K. So if we get stopped out, we lose 3% of our portfolio. And if we get stopped out of this trade, we also lose 3% of our portfolio. This trade has 2 times as big of a position size because the stop loss is closer, but the risk stays the same. Sorry, I had to take a quick drink of water. And then lastly, let's do a little more complicated one, I guess you could say. Let's plan our trade as if our stop loss was 7.31% away, and we want to risk 2% of our portfolio this time. So let's go back. We have a $100,000 account. If we want to risk 2%, that means if I get stopped out of this trade, I only want to lose $2,000. No matter what your leverage is, we want to lose $2,000. We're comfortable risking 2%. And so let's plan our trade based around that. Go back to our equation. We'll plug in 100K times 2% because our updated risk is 2%, divided by 0.0731 because that is the percent distance from our stop loss. And that will give us $27,359.78. So that is our position size for this trade setup. And if it gets stopped out, we're losing that fixed amount that we calculated. So I hope that kind of explains things a little better and helps you understand that the leverage doesn't necessarily matter if you are calculating your position size, and you should always know where your stop loss is. And if you know that, you can calculate how much if you know where your stop loss is and how much you're willing to lose on a trade, then you can safely and accurately calculate your position size. So part 2, I've said this a million times, but this is the idea that I really want to hammer home, because there's so many times that I see people asking like, hey, what leverage do you use? What's the best leverage to use? Yada, yada, yada. And leverage doesn't change your position sizing. It just changes how much of your money is in the trade versus how much is borrowed money. But if the position sizing remains constant, it doesn't matter what the leverage is. This comes down to discipline. Like I said at the beginning of this video, these aren't super complex ideas. They're rather simple. You just have to stick to them. If you know you want to risk 2% on a trade and you're comfortable doing that, don't enter a massive trade where you'll end up risking 10%, or don't enter a trade without knowing where your stop loss is, because then you don't know where you're going to cut your trade and how much you're going to lose on it. And if you don't know where your stop loss is, you don't even know how big of a position size to enter. So it all comes down to discipline. A few other important concepts. Let me just take another quick sip of water. I'm not used to talking for this long straight, so my mouth just starts to get dry. Total trade exposure. This is a pretty big one, especially right now when you want to be in as many altcoins as you possibly can. Let's say you're in 4 different longs and they're all 2% risk. You're not just risking 2% anymore, because if the whole market nukes, you're likely going to get stopped out of all those trades because of the correlation. And that means you're actually risking 8%. So, especially in crypto, because when Bitcoin dumps, all those alts are going to come down with it. And so you need to keep an eye on how much you're risking, what your total trade exposure is. But if you're in one trade and then you move your stop loss up, and let's say you've moved it up in profit. We don't need to specify exactly where. And then you enter another trade. If the whole market nukes, you're not risking 4% anymore. So that way, if you're moving your stop loss up in profit to your new invalidation point, you can be in more trades at once. But it's just something to keep an eye on, because it's probably happened to a lot of people. I know it's happened to me before, where the market dumps and then you're like, oh wow, my portfolio took a bigger hit than I was anticipating, because I didn't really account for the total exposure that I had across the market. So another thing, not a complex thing, it just comes down to discipline. So I don't know where you want to cap that risk for yourself. If you're only comfortable with 5% risk on the market, then do it there. If you're comfortable with 6, 8, do it there. Ultimately, it comes down to your comfort levels, but remember that drawdown graphic that I had at the beginning. So, because then you realize you really don't want to be risking 10, 20, 30%, because you know how hard it is to come back from that. We did mention it at the beginning, but I want to mention it one more time. Drawdown will destroy you. It will hurt you mentally if you see yourself lose a large chunk of your account, and it's really hard to come back from. So please take that concept to heart, and that is just why risk management is so important. It's a long game. All you need to do is survive, preserve your capital. You know, if you survived the whole bear market and now you're trading in this bull market where no matter what you buy, it's pretty much going up, you wouldn't have had the opportunity to be trading this market if during the last couple of years you were risking too much on a trade or on all your trades and you blew your account. So you have to stay alive in this game, and to do that, you need strict risk management. You don't need to only hit home runs. Talked about that a little bit too, where you don't need to be hitting these 8R, 10R, 15R trades. Doesn't mean you are a better trader if you can hit a higher R number. Just means you probably have a lower strike rate. You can be profitable going for those trades, but you can also be profitable and also probably more mentally stable if you're going for smaller ones. So, and then I wanted to attach this little Excel spreadsheet that I quickly threw together to show you really don't need to risk a ton. So let's say we're risking 1% per trade. You're starting with $10,000 and your goal is 10R per month. That isn't absurd. Obviously, you're not going to hit it every single month, but you could overachieve that some months and underachieve it under other months. This is more so just to show you the power of compounding and that you don't need 20-30% winners to grow an account. So basically, if you are averaging 10R a month and you're only risking 1% per trade, after 4 months, you're at 13K. After 10 months, 23. After 16 months, 41. After 2 years, you've turned a $10,000 account into $89,000. And I know people are going to be like, well, how do you know you're going to be able to get 10R a month? That's not the point of this. The point is that even with smaller risk percentages, you can still build up a really strong account. So to conclude, we kept this one right around 30%, or 30 minutes, so that's not too bad. Anyone can master these concepts. It just takes discipline. And once again, position sizing is the one single most important thing that determines your risk. It's not the leverage. Capital preservation is key. You need to play the long game. Don't blow your account, because it is incredibly difficult to make a comeback if you do. So I hope this video was helpful for you guys. If it was, you can subscribe. I'm planning to do more educational videos, so you can let me know in the comments what you want to see next. I've got a pretty good sized list of things I want to cover, but if you guys let me know, then it can help me out with what I should do next and kind of which videos I should prioritize. And then lastly, I want to give a shout out to my sponsor, Bybit. Thanks to them, I'm able to put out this content for you guys for free, and they're also sponsoring me to do 2 live streams per week. So if you guys enjoy my content and want to support me and are thankful that it is all free, then you can consider using my Bybit referral link, which I'll put in the description. Basically lets Bybit know that it's worth their time to sponsor me and that you guys enjoy the content. So I will see you guys in the next video. I hope this was helpful. And don't forget to keep some of the life-changing money that you're making during this run.